Over the last few days, the market has been quite stable as investors continue to bet on better days coming. And while days in the green aren't necessarily the days that I personally enjoy, there are a few dividend stock opportunities out there presenting themselves right now as buys that even the insiders of these companies cannot resist. Therefore, I want to add them to your watch list. So with that, are you ready? Now, investors, earlier this week, we've had a lot of housing and mortgage data that was released, which I don't necessarily think surprised the market or the masses of investors, but be sure you're actually subscribed to the channel because tomorrow we get a closer look into the mind of the consumer with the Consumer Confidence Report. So I want you tuned in on Sunday for more on that because that report could actually be very foretelling of our future. Either way, what matters most is that you aren't timing the market, but rather using all these macro news bites to take full advantage of the sectors that are actually hit the hardest, especially when the company insiders are buying. And therefore, I have 3 discounted dividend stocks that fit our Buffett criteria for investing, from strong leadership teams, reputable brand names, right down to the company balance sheets. So let's go ahead and kick this all off with Blackstone, ticker symbol BX, which has become one of the largest leveraged buyout investment firms in the last few decades, as they have aggressively acquired a whole heck of a lot of real estate and have become a true powerhouse in the industry. Now, a couple things just to note about Blackstone. We're dealing with a private equity firm, but also with a firm that is heavily invested into real estate opportunities. And of course, real estate has been hit the hardest. So with interest rates where they are and probably not coming down anytime soon, this environment is not so great for Blackstone. Therefore, we see it down by 7% on the year, trading for just under $120 per share. But now since COVID, we can see explosive growth with over 236% worth of growth over the last 5 years, thanks to the next to near zero interest rates, and in terms of the last decade, over 523% worth of appreciation. But now some might say that's the past, and they're right. We can't let the past predict the future, but it is promising, with signs already like insider activity delivering us a lot of insight here. Buying activity from their director level, and even some hedge funds beginning to make their money moves on Blackstone. However, it really may take interest rate cuts for this investment firm to actually soar again, and analysts agree with me there, forecasting up to 11% worth of upside, coming up to $133.36 per share. Now, until then, in this whole macro environment shift in our favor, well, we can get a dividend from Blackstone, and we're coming in with a dividend yield at 2.81%, which certainly fluctuates based on our economic environment, but nonetheless, it has really only shown growth over the last 10 years of roughly 10%. But if you're looking for more, perhaps a stable of a play in this environment, I totally get you there, and therefore I want to go ahead and lock you in on Public Storage, ticker symbol PSA, which has more than 2,900 facilities all across the United States while serving over 2 million customers in need of extra space. Now, when it comes to the storage business in and of itself, you have to take note of the fact that customers seeking storage typically don't get storage just for the short term. Talking about a rental property like investment, where they're in it for the longer term. And just speaking materialistically about our lives, I don't think public storage is going anywhere anytime soon. But what I can say is during rougher economic times, well, consumers are certainly cost cutting where they can. So a play like Public Storage would perhaps then be in the red. And that's exactly what we see right now with Public Storage down on the year by nearly 10%, trading for $274 per share. Zoom out with me though to see 135% worth of appreciation over the last decade. And right now, bullishness from the insiders as we see recent purchases of roughly $600,000 worth from a director, all while hedge funds have scored over 65,000 shares this past quarter, indicating strong future upside. As for analysts, they are also forecasting upside, roughly 16% worth of it, coming up to $318 per share. But of course, with Public Storage, it's going to come down to the dividends here because we got a strong dividend yield at 4.38%, which has had a track record here of now being paid out for the last 43 years, all while growing by an average of 10% year over year. Now, investors, just before I cover the next dividend stock that I'm actually most bullish on, we all know that dividend investing gifts all of us with steady cash flow. but we also know the necessity of diversification. And I'm not just talking about diversifying across stocks, but rather ensuring that you have a powerful mix of asset classes within your portfolio for stronger protection against market volatility. And after studying a recent report published in 2022 from Citibank, which illustrated the correlation of asset classes and ultimately found a negative correlation between art and developed market equities like stocks, I think it's actually well worth all of our time right now to look into contemporary art, which sounds like an obscure asset class. That is until you consider the fact that some of the wealthiest investors out there are collectors. Take Paul Allen for an example, Microsoft's co-founder, who sits on a 9-figure plus art collection. In fact, the overall art and collectibles asset class is now estimated at nearly $2.2 trillion as per a study by Deloitte. And investors aren't slowing down anytime soon, as that's actually expected to hit almost $2.9 trillion by 2026, which is why I decided to work with today's sponsor, Masterworks, as their art investing platform has already distributed back a total of over $60 million to investors across their 23 exits. Now, if you're anything like me, not necessarily an art expert, I can assure you that you don't need to be in order to get involved. You also don't need to invest millions of dollars like our good friend Paul Allen, given you can now diversify between multiple paintings. This is all thanks to Masterworks' art investing platform, which offers blue chip paintings to investors in the form of what is most relatable to all of us investors: shares. Now, Masterworks' previous offerings included legendary artists like Picasso, or even our modern day Banksy, and they're nearing over $1 billion of invested capital. So offerings have the potential to, of course, sell out, and rather quickly. So if you're interested in learning more and you want priority access, you can go ahead and scan the QR code on the screen now, or better yet, just go ahead and click down in the link in my description. Of course, all past sales and previous offering demand are not indicative of future results. However, just like our stocks, investing involves risk, and where there's some risk, there is certainly some reward. So I want you to go check out Masterworks right now and let me know what you think down in the comments. With all of that said, we're going to get back to it here with Norfolk Southern, ticker symbol NSC, which is a rail transportation operator that transports industrial products, including chemicals, agricultural goods, as well as metals and construction materials, coal, automobiles, and automotive parts as well. So I'm not talking about a sexy business, if you will, but a lucrative one based on its importance across industry verticals, thus allowing it to flourish over the last decade with over 175% worth of share price appreciation. However, in times like right now, it's a no-brainer that it would actually be down on the year, as it is trading for $225 per share, very similar to other rail operators, given supply and demand shifts across industries from elevated interest rates and inflation. But be optimistic about the economic comeback, just as the analysts are, because Norfolk will certainly kick back into gear with likely over 21% worth of upside in a better economy, hitting the forecasted share price of $272.71 per share. And at this time, even insiders have been all over this investment opportunity, with the most recent buy of over $500,000 coming in from a director on June 5th. But then we can see the hedge fund activity happening here, with over 715,000 shares purchased by smart money last quarter, which makes me very interested in this dividend stock opportunity, given Norfolk also shells out a dividend at 2.4% worth of a yield that has been growing like crazy here by 16% year over year and has remained quite stable over the last 22 years worth of a dividend streak. Now, investors, there you have them. I want your take on all three of these dividend stocks, as well as today's sponsor, and what exactly your game plan is as we close out this week and head into next week. Comment down below. Subscribe now if you're not already a part of this channel. And of course, I'll just make this one easy for you. Catch more insights and dividend stock ideas right here, and I'll see you in the next one.